JP Morgan net revenue was $46.8 billion, up 7%. Net interest income was $25.1 billion, up 7%. Non-interest revenue was $21.7 billion, up 7%. Non-interest expense was $24 billion, up 5%. ROTCE ratio was 18%. Compare with the competitor and EVE record. As of early 2026 data, JP Morgan Chase & Company consistently shows the highest return on tangible common equity. The stock from Q4 2024 was $670 billion. Now was $868 billion, up 30%. While the book value was up 9% or tangible book value per shares up 11, buying back stock of a financial company greatly in excess of 2 times tangible book is a mistake. Loan-to-deposit ratio 58%, while the ratio has climbed from earlier lows 49% to around 56 to 58% by late 2024, early 2025, it remains a sign of robust balance sheet management. JP Morgan ROA for the full year 2025 is around 1.29%. In essence, JP Morgan maintained a healthy ROA in 2025, showing stability and strong asset utilization. JP Morgan achieved a full year 2025 return on equity of 17%. The bank maintained a firm-wide overhead ratio of approximately 51% for the full year, indicating solid operational efficiency. The fortress balance sheet and consistent performance across business segments indicate high quality, stable underlying earnings. Despite navigating normalizing credit conditions and a changing rate environment, the earnings call revolves around the issue of stable coins and potential regulatory changes, especially concerning interest on stable coins and the risk to bank deposits if loopholes aren't closed. Bank executives emphasize that the concerns are shared across all banks, not just community banks, and highlight the importance of regulating a parallel banking system created by stable coins to prevent risks to deposit insurance and the financial system. JP Morgan is actively involved in blockchain and crypto initiatives, like their Connexes platform and partnerships with Coinbase, indicating they see technological innovation as important. They discuss the Apple Card partnership, noting that it takes 2 years to fully integrate due to the built-in, specialized technology stack Apple developed. The executives express optimism about the macroeconomic environment for 2026, citing consumer strength, deregulation, and some geopolitical risks. They discuss expected growth in net interest income, loan and deposit dynamics, and ongoing investments in technology, AI, and expanding their franchise. Regarding expenses, they acknowledge plans to increase tech spending, AI, and other investments to support growth, emphasizing that they aim for long-term profitability and competitive advantage. They also note that the bank's focus is on building technology, improving customer experience, and maintaining strong capital deployment, rather than just short-term cost-cutting or efficiency ratios. Bank of America revenue was $28.4 billion, up 7%. Expense was up 4%. NII was $15.8 billion, up 10%. Efficiency ratio 62%. Bank of America's ROA at 0.89% with related metrics showing positive trends. Bank of America, BAC, reported a full year 2025 return on equity, ROE, of 10.6% efficiency. The company improved its full year efficiency ratio by 146 basis points to 62% in 2025. In an earnings conference call, they said the company's expense ratio guidance is 55% to 59%, and they don't plan to change it immediately due to recent accounting changes. They aim to improve efficiency over time and may lower the target if they make progress. The accounting change already adjusts prior periods to make comparisons more consistent. The company expects organic growth in revenue and expenses, with operating leverage of about 2% in the first quarter, driven by fee growth, loan growth, and expense discipline. They focus on controlling costs mainly through managing headcount and using new technologies like AI, which helps reduce manual work and improve efficiency. Their investment in technology and AI is significant, with several projects underway to cut costs and improve processes. They plan to gradually reduce their CET1 capital ratio from around 11.4%. Using excess capital for growth, share buybacks, and dividends. They expect to reach their return on tangible common equity goals, 16% to 18%, over the next few years by focusing on organic growth, expense control, and leveraging digital and AI efficiencies. Loan growth is expected to be mid-single digits, led by commercial and consumer segments, with some optimism about recovery in mortgage activity, despite very low recent loan loss provisions and charge-offs. They believe these are below normal levels but expect losses to stay within a reasonable range through the economic cycle. They are optimistic about consumer deposit growth, expecting it to reach 4 to 5% annually, driven by normalizing customer behavior and deposit balances after pandemic-related increases. Citi ROTCE was 5.1% from 6.1%, would have to increase to 6.8% excluding the Russia loss. For 2025, ROTCE was 7.7%. Efficiency ratio was 67.1% or 66.4%. YoY revenue was 21 billion, up 8. Excluding the Russia-related charge or 19.4, up 2%. Expenses was 13 billion, up 6%. NII up 14% to 15.67 billion. Tangible book value was 89.3. The team explains that despite flat allocated capital, their trading assets, PV balances, and loans are growing due to strategic deployment in higher return areas like financing and lending, which boosts overall returns, ROTE, even with similar capital levels. They clarify that their target efficiency ratio is around 60%, which is a flexible goal, not a fixed cap, and that they will continue to invest in growth while improving efficiency over time. The progress in their transformation efforts, including data, risk, and controls, is nearly complete, with some remaining work primarily in regulatory data, which is about compliance and validation rather than safety or soundness. The company is confident in their long-term growth prospects across different business lines, aiming for a return on tangible common equity of over 20% in the future. They expect loan growth in the mid-single digits, driven by consumer and commercial activity, with continued momentum in wealth management. Regarding market revenues, they see them as relatively steady in 2026, with some upside from financing and securitizations. The team emphasizes that they balance investing for growth and maintaining expense discipline to deliver higher returns, with a focus on long-term shareholder value. They also discuss their plans for capital return, targeting a CET1 buffer around 100 basis points, gradually reducing excess capital through buybacks. Overall, the message is that the company is on track to increase profitability and efficiency over time, with investments in technology, data, and talent supporting long-term growth. Wells Fargo. Revenue was 21.2 billion, up 4%. NII was up 4%. Expenses was 13.7 billion, down 1%. ROTCE was 14.5, up 8%. Efficiency ratio was 64% YoY 66%. The speaker explains that their expected 2026 NII, excluding markets, is roughly flat year-over-year, primarily due to rate declines offset by continued loan and deposit growth. The outlook assumes about 2 rate cuts and stable forward curves. Loan growth in areas like credit cards will include some promotional rates, intro APRs, 0%, but overall, good growth across the portfolio is expected. They are not seeing significant changes in deposit pricing or trends from initial expectations, with high betas on commercial deposits and already adjusted consumer rates. Regarding credit card rate caps, the company believes the focus on affordability is important but is cautious about potential unintended consequences, such as reduced credit access or increased costs for consumers, and plans to engage with policymakers. The balance sheet growth strategy involves supporting low RWA financing, which doesn't attract much capital, and growing loans across consumer and commercial sectors, with balance sheet expansion balanced with capital and return considerations. They are comfortable with the capital buffer and expect to manage growth and buybacks within their target CET1 ratio range. The team emphasizes that their investments in business growth, including hiring and technology, are ongoing and incremental, not a one-time effort, and they aim to continue expanding their franchise. In markets, funding growth via short-term borrowings, like repo and Fed funds, supports their balance sheet expansion, similar to other investment banks. They see their talent acquisition and team quality as key, with ongoing efforts to add resources as needed, emphasizing that growth is a journey with a focus on quality over quantity.